How to invest when political and financial events have always influenced the stock markets. There are a variety of different types of investments, both long and short term. For most of us, however, investing is a long-term commitment, not a lottery. When investing in the markets, we can't get caught up in the day-to-day roller coaster ride of the trading floor. The reality is, these ups and downs will always happen, but the long-term result is what we're striving for. Patience pays off when it comes to investing. The biggest fear for any investor is the unpredictable market movements caused by political or financial events, such as the stock market crash in 1987, the terrorist attacks in 2001, or the U.S. credit crunch in 2008. This edition of Time magazine was published on March 5, 1984. On that day, the Dow Jones closed at 1,165 points. 10 years later, it was at 3,832 points. That's a 220% increase. $10,000 invested in the Dow Jones on the day this issue of Time magazine hit the stands would have been worth $32,800 10 years later. This issue hit the stands on November 2, 1987. If you invested $10,000 in the Dow Jones on this day, it would have been worth $36,950 10 years later. If you invested $10,000 on November 15, 1990, it would have been worth $42,070 10 years later. Now let's look at a real market scenario. From July 1, 1981 to June 30, 1982, the market went down 39%. Let's assume you invested $10,000 on July 1, 1981 in the Canadian market. 1 year later, your $10,000 is now worth only $6,084. That's a 39% decline. What would you have done? A. Sell your holdings and invest in T-bills. B. Sell and wait 1 year to reinvest. C. Hold on to your investment. D. Set up a regular investment plan of $1,000 per year for the next 10 years. E. Reinvest another $10,000 immediately. Let's see the impact of your decision. Here's how each of the 5 options from the previous graph would have performed. Those who saw opportunity in the 1982 market downturn would have been most financially rewarded in the long run. Even if you did nothing and stayed invested, your investment portfolio would have been better off than selling it as in scenarios A or B. So, where to invest? Dividends. Dividends add portfolio ballast, particularly to uncertain markets. Stocks that pay dividends are more stable and less volatile. What about real estate investment? For most of us, our home is the largest investment that we make in our lives, representing a large portion of our retirement plan. If you look at these figures, you'll see the average return on investment in a Toronto home. So the question is a real estate investment safer than investing in the stock market? Overall, in the long run, both markets offer positive returns. However, in each decade, the stock index provided more stable and regular returns on investments than the real estate market. Real estate versus Canadian equity. What if equity from your home would not be sufficient for your retirement? Let's compare investment performance between real estate and equity markets. In the long run, equity investment consistently outperformed a real estate market regardless of the city in which the home was purchased. With the Wealth Advantage strategy, you can have it both. Increased equity in your home and build a large investment portfolio, all at the same time while you're making regular mortgage payments. Remember that the only thing you cannot buy with any investment is time. The Wealth Advantage strategy allows you to start your investment earlier and build your retirement with sufficient time and comfort. For more information and to receive a comprehensive investment strategy that will be tailored according to your risk tolerance, please contact Paul Banik and Associates.